April 17th, 2020, commercial real estate will need to change in light of the coronavirus pandemic and ensuing economic crisis spurred by the great lockdown, which we'll talk a little bit more about in a few minutes. I'm your host, George Morales of Blue Box Real Estate. Thank you for tuning in to another episode of Coronavirus and Commercial Real Estate as we track the latest news and events and articles related to coronavirus and the commercial real estate sector. Let's tell you a little bit about Blue Box Real Estate and do some housekeeping before we jump right in. Blue Box Real Estate. Find us at blueboxre.com. We're a commercial real estate firm. We provide commercial real estate solutions for South Florida office landlords and office tenants. But in light of these events, we're opening up our services to the entire state of Florida. If you're listening, we're happy to help guide your business through this time. We're offering free, no charge, no cost lease reviews to take a look at it, see what your rights are, see if you have any force majeure or any other provisions in your lease that might protect you or offer a different talking point with your landlord. Please send us a note at info@blueboxre.com. We're happy to help. Also want to say that we have a sister podcast called the Don't Sign the Lease podcast. It's the same title as my book, the Don't Sign the Lease book on commercial real estate. And we're going to start releasing these videos on audio through the Don't Sign the Lease podcast. At Don't Sign the Lease, we've been covering relative subjects to today's events, such as lease reviews, an interview with an attorney. We've discussed business interruption insurance, and the like. So we're going to start preparing these and releasing them on the podcast as well in the short term. That way, some of you who prefer to listen to a podcast for half an hour versus watch a video, you'll have that mechanism and maybe another way that you can share this with those who need to have these resources for their businesses. So with that said, without further ado, we're going to jump right into commercial real estate will need to change in light of coronavirus. So the first two articles really hammer that point home, and we're looking to do a podcast with an architect and get his insight on what's going to change. But this first article comes to us from BizNow New York, and it's entitled ESRT CEO Tony Malkin on offices after coronavirus and preparing for the next crisis. Reading from the article. As New York moves into its fifth week of extreme lockdown, and this article is written on the 13th, extreme lockdown, office landlords are questioning how their businesses will function when the world moves into the new phase, however that may look. Increasingly, it seems that filling spaces with lots of people, the hallmark of office design over the last few years, could be a thing of the past. And quoting from Empire Realty Trust CEO Anthony Malcolm, he said, "There'll be a lot of thoughts about employee density. The WeWorks of the world, convene and industrious, they get called out for their co-working, but there are tremendous numbers of tenants who have deployed benching when you have 2 or 3 feet between people." Now, we actually covered benching in a past episode in an interview with Steve Tews of Tews Design Architecture. Benching is a new term, and that's basically where corporate America has taken a bench, a table, and every 2 feet sits someone with their laptop. Maybe they'll provide providers, and right across from you, you have someone, and right next to you. So literally, within a 6-foot radius, a 6x6 radius, you could have 1, 2, 3, 4, 5 people in front of you. And again, why did the corporate world go to this? It's all cost driven, isn't it? As the market has spiked in terms of rental rates, office tenants have adjusted. They've adapted by putting more people in less space to keep up with the cost. So I see this is going to have to work its way out, and that's what CEO Anthony Malkin of Empire Realty Trust points out. Continuing with the article here, both said that making sure the buildings are well insulated and have large amounts of natural light and have equipment and furnishings that are made of safe and healthy materials will be crucial. And that's Malkin, and also Shanska, who's Chief Sustainability Officer, Elizabeth Hyder. So those are the two that are being referenced here. Malkin continues and says, dense offices are not only crowded from a perspective of elbow room, it's also crowded from the perspective of transmission of germs. I think the big factor here is going to be individual space matters, and we absolutely agree with that. Manhattan office leases fell nearly 50% in the first quarter following the years of record-breaking activity in rents. While some are drawing comparisons to the 2008 financial crisis and the September 11th terrorist attacks, Many acknowledge this is an unprecedented scenario with little historical context for a guide. And I went through both of those events when I was in commercial real estate, still am in commercial real estate. But I was with Alan Moore's company. I was working in-house with a developer in 2001, and I was with JLL in the financial crisis. And the one consistent about both of those is we still had restaurants open, businesses remained open, you still can go to church on Sundays. We weren't under lockdown as we are now, and certainly the recovery didn't drag in terms of getting life back to normal. Even though specifically after September 11th, it seemed like the rest of that year, 2001, the business community just froze. Didn't know what to do as we were living in a new world. And we've got a lot of questions yet to be answered about this virus and how we're going to get back to normal. Continuing with the article, still the working from home movement may seem like a bright new penny, Malcolm said, but he doesn't think it is likely to become the way of the future. I think we're going to see more space for individual employees, Malcolm said, adding ventilation and heating and cooling systems as well as a renewed focus on health and wellness will come to the forefront. He added that the current crisis should force companies to think longer term, plan for the future, and focus less on short-term gains. Another quote, if there's one thing that's coming out of this economic impact from COVID to me, it's the degree to which people have not been well capitalized enough to prepare for the unexpected. He said, if you're better capitalized, you'll have more confidence in taking longer-term action. And I do think as landlords go forward and as they review the credit applications and balance sheets of companies, they're going to want to see more of a capital reserve to weather 1 or 2 months of storm in case another force majeure event happens. So that is one article from BizNow. The next comes to us from McKinsey & Company. Okay, they're private equity and principal investors, but they had a great article on the title, Commercial Real Estate Must Do More Than Merely Adapt to Coronavirus. And this is thanks to, 4 or 5 key figures there. Let's continue. COVID-19 is a humanitarian challenge that will have lasting effects on how people live, work, and play. By acting today, real estate leaders can best serve end users and ensure their own viability. A lot of nuggets in this article. So forgive me for bearing ourselves in here a little bit, but given that it is the theme, commercial real estate is going to have to change. We glean a lot from this. Thank you, McKinsey. Physical distancing has directly changed the way people inhabit and interact with physical space, and the knock-on effects of the virus outbreaks have made the demand for many types of space go down, perhaps for the first time in modern memory. This has created an unprecedented crisis for the real estate industry. Beyond the immediate challenge, the longer this crisis persists, the more likely we are able to see transformative and lasting changes in behavior. The immediate change. Over the past several years, real estate investments have generated steady cash flow and returns significantly above traditional sources of yield, such as corporate debt, with only slightly more risk. Since the virus outbreak, however, this reality has changed and real estate players have been hard hit across the value chain. Think of the many institutional owners, specifically insurance pension funds who own major commercial real estate. This is consistent returns. Well, all that's getting disrupted now. Many developers can't obtain permits and they face construction delays, stoppages, and potentially shrinking rates of return. Meanwhile, many asset owners and operators face drastically reduced operating income and are almost all nervous about how tenants will struggle to make their lease payments. Concessions and abatement are the words of the day, and players are working rapidly to figure out for whom they apply and how much. This is a conversation happening all across the globe. It's not just the United States conversation. It's not just the South Florida or Miami or Coral Gables conversation. This is an entire global conversation that tenants and lenders are having. Assets that have greater human density seem to have been hit the hardest. Healthcare facilities, regional malls, lodging, and student housing have sold off considerably. By contrast, self-storage facilities, industrial facilities, and data centers have faced less significant declines. Obviously, there's less human capital in those spaces. For example, within commercial office space, the multi-year trend towards densification and open plan layouts may reverse sharply. Again, the hallmark of putting more people in less space might be reversed sharply. Public health officials may increasingly amend building codes to limit the risk of future pandemics, potentially affecting standards for HVAC, square footage per person, and amount of enclosed space. We recently toured, end of the year, toured a co-working group, very famous. We won't talk about them, but we visited this place, and I asked that question. You know, the codes in South Florida, the local codes say 10 per thousand. You can't have more than 10 people per thousand, but in one instance, they had a corner, 800 square feet, had 30 people working in a glass box, 30 people in a glass box of 800 square feet. I said, how does this happen? How does the building code inspectors, when they come through here, they approve these space plans? They said, oh, we've never had any problems. And I think they will have problems going forward. I think they're going to get more scrutinized. Plus, I think the workers aren't going to put up with it. They're not going to return back to work when they're crammed in an 800 square foot glass box with 30 of their coworkers. So I do think we're going to see some major changes in that coming. And maybe the at home work is going to supplement that. The COVID-19 experience could presumably permanently change habits that may affect demand for other real estate assets, such as hospitality properties and short-term leases. Even a short moratorium of business travel could have lasting impact when alternatives such as video conferences provide or prove sufficient or even preferable. Nearshoring of supply chains may further reduce demand for cross-border business travel, and consumers who are afraid of traveling overseas may shift leisure travel to local destinations. What they're getting at is behavioral changes. You know, we're told if you do something the same thing for 30 days, if you exercise the same thing for 30 days, you read your Bible every day for 30 days, or get in the habit of reading for 30 days, or getting up early for 30 days, it becomes part of your behavioral system. And well, we've had more than 30 days. If you think about it, we've had a tremendous experiment that would never have happened if it wasn't forced upon us, where the corporate world for the last 30 days, and it's probably going to be closer to 45 or 60 days, has all involuntarily sent their workforce home. We have this grand experiment taking place. What's happening? Are the workers as efficient, productive? What about company morale? All these questions are now going to be answered globally, certainly across the US, due to COVID-19. And we're in the middle of this experiment. And the corporate world's going to determine, hey, you know what, that wasn't so bad. Or you know what, that was a disaster. We can't wait to get everybody back in the office. But for the first time, we're finding this out in a way that would have never, ever happened. And so that's going to change patterns. It's going to change the way companies move forward after the coronavirus. Before the pandemic, consumers were already shifting their spending away from physical stores, now talking about online buying. This long-term trend may accelerate even faster as the crisis, after the crisis, especially as many previously struggling brands are tipped over the edge into bankruptcy and forced to radically reduce their footprint. So consumers forced to shop online because of malls closed and department stores closed and so forth are perhaps going to just permanently change. The shift to e-commerce may also further boost already high demands for industrial space, a little silver lining for industrial space. However, behavioral changes that will lead to significant space become obsolete in a post-coronavirus environment seem imminent. Just too long a pattern, too long, and people are going to change their habits and patterns. And so let's finish off this article here now, talking about concessions in commercial leases and making them more tailored for commercial tenants. Nearly every landlord is preparing for the effect of the downturn, when scores of tenants across asset classes will ask for lease concessions or abatement. In the office sector, factors such as the price point in the market, tenant renewal probability, tenant default probability, local regulations, building appearance due to vacant spaces, and potential reputational risk should inform individual decisions. That's a great little smorgasbord of things to consider when you're talking to a tenant on behalf of a landlord. What's the default probability? Can they survive this? What's the renewal probability? What is that renewal? What are the local regulations? What are the eviction laws currently? What's going to be the appearance of the building with vacancy, especially your ground floors? And the reputational risk. You know, most landlords have a good reputation, I would say, in markets, especially in South Florida. And you want to be known as one of those landlords that help their tenants, as opposed to really came down with a hammer on their tenants. That's going to get around. And it's going to make it more difficult when things rebound to get that next tenant in there. Some landlords are now starting the process of thinking ahead to when the crisis is over. The article continues. Will employees demand larger or more enclosed workspaces and so forth? I know one of my landlords is taking great precautions. There are systems out there, cleaning systems that come in where they'll kind of come in and fog down common areas and tenant spaces. In fact, one of our landlords is preparing to do that. It's very costly, but I think it gives some assurances to tenants that the space will at least be cleaned and cured of any bacterial or virus that could have been there prior to opening. Now, after opening, it's going to be incumbent on tenants to wash hands, use hand sanitizers, and so forth. But at least landlords are taking into consideration of getting some massive cleaning before they open and implementing some policies. So that is the impact of COVID-19 on the real estate industry. Thank you, McKinsey. In other news, we're going to look at a couple of the next few articles. Buckle up, because it's not great news still, though the stock market seems to be rebounding. And we've picked up quite a bit of gains the last few weeks since the thing bottomed out around 19,000 and change. Now we're back, as of last I checked, between 23,000, 24,000. So I don't get it. I'm not a stock expert. I have friends who are. Happy to recommend some. But the stock market is rebounding somewhat, but the news continues to be negative. Here, the IMF, the International Monetary Fund, put out an article, and they predict that this economic crisis will be the worst since the 1930s. So it's hard to put a ribbon, a bow on that news, but just to read a little bit from their executive summary, the COVID-19 pandemic is inflicting high and rising human costs worldwide. Protecting lives and allowing healthcare systems to cope have required isolation, lockdowns, and widespread closures to slow the spread of the virus. The health crisis is therefore having a severe impact on economic activity. As a result of the pandemic, the global economy is projected to contract sharply by -3% in 2020, much worse than during the 2008-2009 financial crisis. In a baseline scenario which assumes the pandemic fades in the second half of 2020, which we're mid-April now, we're only about 45 days, 60 days from starting to enter the half. So the baseline scenarios are assuming that things get back to normal and the virus fades away. And I think every week that goes by, we're all kind of seeing that may not be a reality. But the baseline scenario, which assumes the pandemic fades in the second half of 2020 and containment efforts can be gradually unwound, the global economy is projected to grow 5.8% in 2021 as economic activity normalizes, helped by policy support. There is, however, the article continues, extreme uncertainty around the global growth forecast. The economic fallout depends on factors that interact in ways that are hard to predict, including the pathway of the pandemic, the intensity and efficacy of containment efforts, the extent of supply disruptions, the repercussions of the dramatic tightening in global financial market conditions, shift in spending patterns, behavioral changes such as people avoiding shopping malls and public transportation, confidence effects, and volatile commodity prices. Many countries face a multi-layered crisis comprising of health shock, domestic economic disruptions, plummeting external demand, capital flow reversals, and a collapse in commodity prices. Risk of a worse outcome predominate. Now, listen, they predict a complete rebound in 2021, a 5.8 growth in GDP, and then they come back to the next paragraph and undermine that whole projection by saying, however, there's all these things, the sky is falling, and we don't know what's going to happen. So anyhow, you can read the rest of this. It's just not good news. They continue. I'll read the last section here. Strong multilateral cooperation is essential to overcome the effects of the pandemic, including to help financially constrained countries facing twin health and funding shocks, and for channeling aid to countries with weak healthcare systems. Countries urgently need to work together to slow the spread of the virus and to develop a vaccine and therapies to counter the disease. Until such medical interventions become available, no country is safe from the pandemic, including a reoccurrence after the initial wave subsides, as long as transmission occurs elsewhere. So you see what they're saying is this is a global issue, and until there's a global vaccine and until the world rolls up their sleeves and helps other countries, it's not enough if the US recovers or if China recovers or if Spain or Italy. If Spain recovers and Italy hasn't, then there's still going to be cross-contamination, and we're a global community now. So if the US recovers but Canada hasn't, or Mexico hasn't, or Nicaragua hasn't, it's all just going to keep unwinding. So the sooner we get to a vaccine, according to the article, the better. And so that's certainly one way to look at it. The other way might be the sooner we get to herd immunity as a world, perhaps that will make a difference. But I will let you read this. And again, let me remind you, all these articles that we're covering, we're posting daily on our LinkedIn Blue Box corporate page. So I encourage you to go to LinkedIn, pause the tape, go to LinkedIn and look up Blue Box Real Estate and follow us. We do have a growing number of followers. Thank you. We're promoting these articles plus our own content, including these videos and podcasts and articles out on a daily basis. So keep up with the latest news. We're here for you. The next article comes to us from BizNow London. Again, Mike Phillips, 57%. That's how much rent was paid to UK landlords this month. UK landlords collected just 57% of rent they were due at the end of March, according to an in-depth survey. Given the extent of the impact the coronavirus has had on the economy, it's hard to know whether that is a good result or not. We don't know. We'll probably find out in the next. Now, UK collects quarterly. If you've listened to these video casts, you'll know already UK, something we all learned together, collects on a quarterly basis. March 25th, the next 3 months were due, only 57% came in. Now, the barometer, this comes from Remit Consulting surveyed, okay, over 78,700 leases and more than 18,350 commercial and residential properties across the UK. So that's a wide swath. So I think these are good numbers. But a week after the March 25th quarter day was due, just 57% rent owed has been collected. That compares to 90% for the same period of 2019. So there's the tail off, 33% if my math is right. Which frankly may not be that bad. We don't know. We'll probably know when the next quarter is due. So it's March, April, May, June. June 25th will be the next quarter due. Let's take a look. But they're off 33% from this time last year, 90% collected. And now let me continue. Retail fared worse. They just collected 47% within the week of the quarter day. Residential also saw just 47% of rent collected. So I would imagine they go hand in hand because a lot of folks who are renting may be more hourly minded or wage workers versus salary wage workers perhaps. So here it is in mirror, 47% of retail and residential rent collected. The 3-month ban on residential evictions for non-payment of rent meant that tenants have not paid without providing an explanation. So how much of that is actual need versus, hey, we don't have to pay for 3 months, we can transfer that capital, put it to use somewhere else? We don't know. Remit's data shows that, and this is consistent here in the US, I believe, the offices have been the most resilient real estate sector. A total of 71% of office tenants paid their rent within 7 days of the quarter compared to 62% of industrial tenants. I just spoke this morning to a landlord client of ours at Blue Box Real Estate, and they collected 91% of April's rent, and we're working with those who are having concerns. So that's pretty good in light of what's going on. I mean, according to the IMF, the worst economic crisis since the 1930s, to receive 91% of rents, and in another market, they collected 99% of rents. So I have a feeling that the outlook for the office is going to be much more resilient and better than retail. I guess the question again becomes, what about May's rent? What about June's rent? How long will this go until we can get back to normal? I think we'll see some slight declines. But office in the US is showing to be resilient, at least as a very small sample size of South Florida offices. Next article comes to us from South Florida Business Journal. These are the latest, and again, I told you, buckle up because the next 2-3 articles have to do with just massive layoffs. These are the latest South Florida companies to lay off and furlough workers. So this is just South Florida. What just a massive list. The Holiday Inn Port of downtown Miami laid off 72 workers. The layoffs at the 200 hotel room were expected. The Mandarin Oriental Hotel, this is on Brickell Key, luxury 5-star 329 room hotel, just laid off 488 employees. Well, that was effective March 26th, so that's been some time. 488 employees. The Four Seasons at the Surf Club Hotel and private residence laid off most of their directors in major departments, including directors of sales, so we don't have the number there. Restaurants. Mediterranean restaurant Bagatelle, I guess I'm pronouncing it, at Miami Beach laid off 55 employees. The casual Cuban restaurant Casa Cuba laid off 46 employees. Earl's Kitchen and Bars, 138 employees. They're located in Miami's Dayland Mall. Again, this is really sad, especially some of these that are hitting home that we know of. Earl's Kitchen and Bar, 88 employees laid off. No, they were 88 at the Orlando location, 138 in the Miami Dayland Mall. Sugarcane Raw Bar and Grill shut down operations, laid off 93 employees. but it's also impacting others. Manufacturing. NFI, a Doral-based third-party logistics provider, laid off 64 employees. NFI at its Doral warehouse facility. Insight Optical Manufacturing Company of Florida in Hialeah laid off 71 employees. And then obviously in retail, 71 staff were laid off at Paradise Broward. So that's just the latest from this last week. Layoffs are continuing to come in record time here. The next one I want to talk about is a little bit larger scale. You know, the South Florida market, it relies heavily on the cruise industry. Norwegian, Carnival Cruise Line, Royal Caribbean all have their headquarters with us. And Royal Caribbean announced they're going to lay off or furlough hundreds of South Florida workers. Miami-based Royal Caribbean, this comes from South Florida Business Journal, Matthew Rojas. It will lay off or furlough 26% of its workforce, including hundreds of workers in South Florida. The company that traded on the New York Stock Exchange, RCL, second largest cruise company in the world, sent a memo on Wednesday to its more than 5,000 U.S. employees announcing the layoffs. Most of the layoffs are permanent, but some are 90-day furloughs, said Jonathan Fishman, Royal Caribbean's corporate reputation manager. The circumstances of the pandemic made the action unavoidable, and it hurts to part ways with so many good and talented people. Approximately 4,000 of the Royal Caribbean workers are based in South Florida. That comes after they let go 850 technology and IT contractors as a result of the pandemic. So that's Royal Caribbean. Again, very close to home here, South Florida. Now we're going to turn the tide here a little bit and start focusing on some more positive news, the last 3 articles. And one of them is, hey, one of Miami's own received their PPP loan funding like right away. And so pay attention. Maybe we're lucky, says the company. And here we see that Pro Energy, a Medley-based fuel distributor founded by Clemente Cruz in 2000, had 158 people on payroll in early March before the coronavirus pandemic shut down the economy. Demand for fuel plummeted after social distancing guidelines, and none of us are driving, right? I mean, you know, very thankful that the auto insurance industry is giving folks 20% reductions. They should. No one's using their cars. But without any help in sight, they made a decision to cut 51 employees, is Pro Energy. The government cracked down and people stopped driving. We just didn't have business, said Cruz. But the layoffs didn't last for long, the article continues. After submitting a Paycheck Protection Program loan application through Synovus Bank on April 5th, Cruz said he had the funds and the ability to rehire his staff in his bank account 8 days later. 8 days later. So listen, I don't know if you haven't applied yet, you might want to consider Synovus Bank. Synovus Bank, well, we'll get more to about them. I've read so many horror stories about the application process, but for me, it was a walk in the park, said Cruz. We'll continue the article. Synovus Bank gave him a positive experience. The bank, he said, was in frequent contact with him every step of the application process, from the moment he began his application to the day the loan was funded. My banker was phenomenal. He updated me through the week, so I knew the application was moving along. Maybe we got lucky, but they treated me like I was their biggest client, which I am not. Synovus is a regional bank based in Georgia, acquired Florida Community Bank in 2019. So there you go. Great plug for Synovus Bank. If you're listening and you're considering applying for the payroll protection program, maybe consider Synovus Bank. I wish he mentioned his banker so you can call him and give him some props. So One South Florida already got funded. The next article comes to us from Erica Murphy at Globe Street. She's been providing quite a bit of good news for us. And thank you, Erica. And this is regarding New York Hospitality Alliance unveils its plan for economic recovery. And we're seeing more and more of this. I know the president has put together an alliance of business leaders and commercial real estate industry leaders. Yes, a lot of them from New York, but to start looking at how we can open up the economy gradually. I think that's all positive. So here we have New York Hospitality Alliance work with a variety of business groups to come up with its blueprint to save small business. And they came up with 4 key policies to resuscitate ailing small business and revamp the economy. Now, hopefully our leaders are listening to this. Some of these I think have more of an opportunity to happen. All of these primarily require federal assistance, which you wonder, how long can that last? Insurance, number one policy. Business interruption insurance claims related to COVID-19 should be required to be paid, or specialized business recovery funds should be established to promptly pay claims that to businesses required to close by government order. Where, and here we go, where necessary, the federal government must provide the insurance companies appropriate assistance. So they're wanting change to business interruption. I just don't know how you can backtrack, how you can change things in retrospect and force insurance to cover it when it wasn't. For the most part, pandemic is not part of business interruption insurance today. Second, amending the Paycheck Protection Program. Okay, the Paycheck Protection Program of the CARES Act should be amended to allow the loan to be forgivable if businesses hire back needed staff at a minimum of 6 months after they fully reopen, allow a larger allocation of the money to be used for rent and other expenses, and expand the stimulus funding so it's available over a longer period of time. Okay, yes, wonderful, beautiful. Extend it. If you hire back your full staff within 6 months, again, that presumes that within 6 months, restaurants are back to normal and everyone's back to shopping and we're back to where we were pre-coronavirus. Is that enough time? Who knows? Allow larger allocation of money to be used for other things such as rent and other expenses. Yes, wonderful, but again, and have it to be forgivable. But again, the government doesn't produce anything. They're takers. They take from our income and capital and work, and they use that to fund these things. So the money's coming from somewhere, and to make everything forgivable and just spend more and let's go more 6 months and do things. It all sounds great in theory, but again, I mean, we're going to be walloped with massive taxes and inflation going forward. At some point, there's got to be some answers that don't involve the federal government so much, further taking away our money in order to help us. It's like taking my $20 and giving us back 10 and saying, I'm helping you. We have to think of more private sector, in my opinion, responses to helping small businesses. But now this one I like though, because it involves taxes. This one I like because it doesn't involve, it involves, if anything, returning things to us. Sales tax. The group says that it recognizes the state and city of New York face significantly budgetary constraints. Nonetheless, it is recommending investigating the fiscal implications of converting restaurant, nightlife establishments, and retail stores' sales tax collection into grants. Love that. I love that. We're now converting money that we're taking into grants as opposed to more loans and so forth. Since these monies are on hand, converting or reverting the sales tax collection into a grant will help small businesses immediately with needed cash and will stimulate economic activity. Now you're talking good language here, kind of good libertarian language, so to speak. Convert sales tax. Just put a freeze on sales tax alone might spur people to come in. How about property taxes? All of us had to pay by March 31st, including both commercial and residential. How about giving us a break on the property tax? How about giving us a break on sales tax? How about cutting our income tax for those of us who still have income coming in? Helping on that end as opposed to refunding us. Taking to refund. How about take less and use that to spur during these times? Sales tax, great suggestion. And then rent and mortgages. This is the fourth one. Due to the ongoing COVID-19 emergency, businesses and property owners face significant challenges. The group says the majority of businesses in New York City have been mandated by the government to close or limit their operations, and many therefore cannot pay their rent. Property owners have financial obligations, including property taxes, mortgages, maintenance, and capital improvements, much of which is paid by the rent from their business. Therefore, we recommend a government backstop be provided during this emergency. Again, wonderful, government backstop. These government programs could include indirect federal financial assistance, rent and mortgage forbearance, and other property tax deductions for landlords who provide rent concessions to their tenants. I don't know how we just keep relying on the government to backstop everything. We're getting just massive government, massive debt. We already have debt, so much, and we're adding to it that our future generations are gonna have to deal with. I don't see a long-term plan for the government to backstop everything. They can't send everybody a check for 6 months, pay everybody's mortgages, pay the lenders, give grants. This just is not really possible. But 4 suggestions from the New York Hospitality Alliance. Again, these are suggestions, but at least the business world is considering how do we get out of this, and I think those are good conversations to have. The last article, very simply, I want to highlight a sale that happened in our local community in Miami Lakes. This thank you to CRE Sources, Debbie Colangelo. And if you haven't subscribed to CRE-sources.com, let me put a plug. She does a great job of getting information out there, especially Florida news, to us in the brokerage community. So subscribe, find her and subscribe to her subscriptions here online. Personal injury law firm acquires office buildings for new headquarters. The Ward Law Group, one of South Florida's largest personal injury law firms, focused on Hispanic community, acquired an office building in Miami Lakes for $11.5 million. Okay, the deal closed April 10th. So obviously this started before, but it still, I think, indicates it's a good time if you're an owner user. It might be an excellent time. In fact, I'm talking to some of my tenant clients about looking for property. You might be able to pick up something highly discounted. Interest rates are low, might be a good time to convert rent into mortgage payments. The 3-story office building located at 6625 Miami Lakes Drive will become the firm's new headquarters. The seller was Miami Lakes Commons LLC. The building totals 52,745 square feet, so roughly 200 a foot plus or minus at 11 million. And congratulations to Greg Ward and the Ward Law Group for continuing with your strategy. You know, if you had a strategy, especially a real estate strategy, and you were going in one direction, and here the pandemic hits, you know, I applaud you to continue moving in that direction and not moving forward. Now, you don't know if the monies were hard and they had to close. We don't know. We have a closing, God willing, in the next few days at Blue Box Real Estate for an office property as well. And we're hopeful that that will continue to move forward, and maybe we'll be talking about that next week. So again, a reminder of a few things. If you haven't gone to LinkedIn, go to LinkedIn. If you haven't gone to blueboxre.com, subscribe. If you have a lease anywhere in the state of Florida and you wanted just a free review from professionals, we're happy to look at it and outline a real estate strategy for you. If you have too much space on your hands and you want to know what to do, sublease is a good option. Talk to us about it. Again, reach us at info@blueboxre.com. And we're going to start promoting these video casts also through the Don't Sign the Lease podcast if you prefer to listen to these. I would say if you're in the car, but most of us are at home still, but maybe you're working out or doing some yard work, and maybe you'd rather listen and learn as opposed to watch and learn. So we'll end, as we'd like to do, with a reading from God's Word. And these are comforting words from the book of Psalms, the Psalm of David, Psalm 27. And this is just one verse. And this is a verse that I memorize, and this is a verse that I like to have my kids memorize, and we'll quote to them at bedtime, where we can find our rest and hope and security in the Lord. So Psalm of David, Psalm 27. The Lord is my light and my salvation. Whom shall I fear? The Lord is a stronghold of my life. Of whom shall I be afraid? What a comforting word for those of us who know the Lord, to know that He is our light and our salvation. Whom shall we fear? Okay, I've been asked a lot. I've had some calls this week. Hey, how are you guys doing? Are you needing any help with the payment protection program or the CARES Act? Or I said, no, praise God, we don't. We haven't had to go into debt as a firm ever. Bless the Lord, and we're not going to now. And ultimately, it's the Lord who provides. He is our light. He is our salvation. He is a stronghold of our life. Whom shall we be afraid? So yeah, these could be scary times. But God has led us through this, and we will get through this with His help going forward. So I hope you found some comfort from God's Word. Again, thank you for tuning in for these coronavirus and commercial real estate video casts. And for Blue Box Real Estate, I'm George Morales. I want to thank you for tuning in. Have a good day.